Welcome back, everyone. In today's video, I'm going to be speaking about 3 important things every dividend investor should know. And now these things I wish I knew when I first started dividend investing. I know that there is quite a bit of information out there about dividend investing as a whole. So I think that these 3 things are some of the most important factors to consider. And remember, if you do enjoy content like this, please consider subscribing and liking the video for future content. So number 1 on this list, dividend ETFs and dividend stocks typically fall into 2 different categories. Dividend yield like JEPI and dividend growth like SCHD. And I'm going to show you what I mean by that. I think a decent example of a high yield ETF is SPHD. That is the S&P 500 high dividend low volatility ETF. This is basically a ETF that provides a high dividend and pays monthly. And I want you all to pay close attention to the cash amount column here. Notice how this dividend remains pretty much the same over time, and in some instances, it goes down. This is an indication that the ETF doesn't really grow its dividend overall over time. And on the other side, we have VIG, or the Vanguard Dividend Appreciation ETF. And if we look at the cash column here, what you see is a dividend that increases steadily over time. It's true that there are ups and downs, but if you go back, you do see that this dividend grows nicely over time. And that is just to show an example of price appreciation in regard to dividends. So really, what does that mean for a dividend investor? Well, in the case of SPHD, since it is a yield ETF, if we go off the NASDAQ page, if you invest $100 into this ETF at 4%, you're going to get $4. And basically, if you invest $100,000, you're going to get $4,000 per year. Now, that is going to be your initial set value. So that is going to be decently high in comparison to the dividend appreciation ETF. Now, with VIG, the initial yield is lower from the NASDAQ page. So if you invest $100, you're going to be getting $2.03, or if you invest $100,000, you're going to be getting $2,030. However, that is going to change quite a bit in regards to yield on cost. So here's a spreadsheet I made to teach you all about the power of yield on cost. So I put this formula in at the current rate, and I did an initial share price of $100 for each to show you the value in a simple way, and I kept the dividend per share the same. So $4 on $100 would be 4%, and $2.03 on $100 would be 2.03%. So in the first year, you're going to be getting a dividend of $4, and in the first year for VIG, you're going to be getting a dividend of $2.03. Now, the dividend growth rate I kept at 1% for SPHD. If you remember SPHD's dividend, it basically didn't go anywhere, and in some cases it went down. And if you remember the dividend growth of VIG, it increased quite substantially. So in the first year for SPHD, this is hypothetical, if it increased the dividend by 1%, then in the next year, you'd be getting $4.04. So let's forecast that out after 15 years. So after 15 years on your $100, your yield on cost would be $4.64 on that $100 that you invested today. Now, if you do the same thing for VIG, you're really going to see the power of yield on cost here. So that is now $7.39 for that $100 that you invested now. So that really just goes to show you that $100 invested in VIG will grow quite a bit more over time in regard to the dividend than $100 invested into SPHD, which is a high dividend yield ETF, because of that dividend appreciation that VIG provides. Now, if you need high yield today, if your time horizon isn't that long and you need high income for your living expenses, of course, a high dividend yielding ETF like SPHD might be ideal. But if you're younger, then a dividend appreciation ETF will give you more compounding growth over time. Important part number 2, and I think a lot of dividend investors may not like this, but this is a reality that we all must face as dividend investors. and that is dividend investing will probably underperform the wider market as a whole. So what I did was I put $10,000 in and I put that up against the S&P 500 ETF VOO, and I basically compared that with three very popular dividend ETFs. That's VIG, SCHD, and VYM. And if we scroll down, we can see that between January 2012 and February 2024, a decent 12-year span there, these dividend ETFs, every single one of them underperformed, and now this is even with dividends reinvested, the wider market. Now, there is probably one major reason to that, and that is because the S&P 500 does not include these super well-developed companies. Typically, when you see a dividend-paying company, they are well-developed, and there isn't as much room to expand in growth. Now, that is a generality. When you do have higher-paying dividend companies, they're usually developed throughout their entire market. So with the S&P 500, you really get that huge amount of growth companies in there. We're talking about things like Amazon, Facebook, Tesla, Google, companies that don't pay dividends but have grown in capital very substantially over the past decade or so. And if we compare that to other ETFs on this list, you do see the higher the dividend, generally the lower the ETF performed, and SCHD is kind of a special case because it is like such a good dividend paying ETF. But when you look at VYM, which is a high dividend yield ETF, you see that it performed the worst. Now, again, this may not be forever. Like if you notice in a short instance here, SCHD was on top for a little while. It did a little bit better than the S&P 500 for a very short period of time. So that may change in the future for brief periods. But overall, I want you to all keep in mind that the companies that the general market, like the S&P 500, will hold will include these growth companies that have greater room to grow than these well-developed companies that pay dividends. And if you also hold this in an account that isn't tax advantaged, you are going to be paying tax on those dividends as well. So that is another important factor to consider when it comes to growth that may hinder appreciation over time. Moving on to important factor number 3, which is great because we can do it all in one by combining this graph and this chart. Probably what's the best thing about dividend investing, in my opinion, is its resistance to change. If you notice, the S&P 500 has the highest standard deviation of all of these ETFs here. So you're going to see those ups and downs hit a lot harder than an ETF like VIG or SCHD. And you notice that the worst year was major compared to all of these other dividend paying ETFs. You see that it is even twice the amount almost as the next highest one in regards to the worst year. Now, the best year isn't too far off either. So this pretty much performs in line when times are good, but really resists change when times are bad. And I probably think, other than, of course, passive income, that when it comes to dividend ETFs, that's probably the second most important reason why people invest in that rather than these growth stocks or the S&P 500 as a whole, because it is seen more so as a conservative investment that doesn't change as much over time versus the overall market. And I am primarily a dividend investor. I do have the majority of my equities in dividend paying ETFs. So I do hold SCHD and JEPI. And in my growth fund, I have the dividend ETF that I showed in this video, which is VIG. I do think it is a great ETF in itself. So I still do believe in dividends, even with them maybe not performing as well. I like the stability that they provide, and even more so, I do enjoy the passive income that it provides as well. Tell me some of the reasons why you like dividend investing, and tell me if you knew these things when you first started. I know I didn't. I was very confused about the difference between yield and appreciation. When I started, I thought yield was all there was to it, and that was it. But I fell in love with dividend appreciation, of course, because I am a bit younger and I have more time for my money to grow. Remember, if you did appreciate this content, leave the video a like and subscribe for future content, and I'll see you all in the next video.